Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling for a second day as the trade war hits corporate earnings. Ford falling this morning after pulling its financial guidance and warning that tariffs could cost the company up to $1.5 billion. It's just the latest automaker to point to the steep costs of the trade war. President Trump has said 25% tariffs imposed on imported vehicles and parts are needed to bring more production and jobs back to the U.S.
Plus, Palantir shares sinking this morning after its financial results failed to live up to investors' loftiest expectations. The company bumped its 2025 revenue forecast to about $3.9 billion. That represents growth of 36% from 2024. Having recently ridden a wave of AI enthusiasm, Palantir shares were trading at more than 200 times estimated earnings, making it the priciest stock in the NASDAQ 100 index by that metric.
And the Federal Reserve kicking off its two-day meeting in Washington today, with investors expecting the central bank to keep rates on hold. But optimism over the prospect of an interest rate cut next month has been rising. Investors will keep a close eye on Fed Chair Powell's press conference tomorrow for more details.
U.S. stock futures are lower this morning for a second day after the S&P 500 came off of its best winning streak in 20 years, which helped erase all of its Liberation Day losses. But Wall Street strategists aren't convinced of a smooth path ahead. Here to break down if the tariff optimism has run its course is Yahoo Finance markets reporter Josh Schaefer. And okay, now there's some optimism, I guess, but there's still this lack of clarity around what deals will net out like.
Yeah, it seemed like, Brad, over the last 2 weeks as we went through this rally, kind of the key parts that we were hearing about trade deals was, well, there's discussion, right? And initially there obviously wasn't discussion, so it seemed like that was sort of the positive news. There's been some discussion. You have multiple members of the administration saying they're nearing deals in the last week. Now it seems like strategists want to see a deal. Right? What's a deal actually look like? And then how's the market react to that deal, right? So we sort of positively priced in that the deal would bring down the tariff rate for whatever the given country is, but what is the actual number and how does the market sort of react to that remains a looming question. I think the other pieces of this rally that sort of stand out is earnings have been relatively solid for the quarter, right? Of course, you guys mentioned Ford from last night, perhaps not as solid, removing that guidance, but generally going back to big tech last week, that was certainly a part of this rally, right? And you've seen stocks react positively to earnings. That's helped move the index higher. Lori Calvasino over at RBC Capital Markets, though, highlighted maybe that's starting to run its course. What's my next catalyst, right? And the next catalyst is probably more information on trade deals. And then also you have the Fed meeting tomorrow. And I think a lot of people want to hear a little bit of a quote unquote dovish Powell, where he's perhaps ready to step in with rate cuts if needed. And investors want a little bit more assurance on that front as well. But it feels like after rising about, I think it was roughly 14% from the bottom, time for a little bit of a new catalyst here, and we can't just keep going up forever, right?
And we don't have any trade deals at this time. The president over the weekend saying that a deal with China could come in up to 2 to 3 weeks. Deals could come as soon as this week for other countries. To what extent are the sources you talk to really relying on those trade deals specifically as the next catalyst, or are they okay with some other catalyst coming in here?
I think it mainly seems like a trade deal specifically in the next couple of weeks, Maddie. Like in the next, probably by the end of May, right? I think people want to see actual progress start to happen, because remember, another key part of this story we've been talking about is sort of just how uncertainty plays a role in the economy, right? And so if we don't know what the actual tariff rates are going to be, that continues to freeze businesses, that continues to be an overhang on overall activity. So it seems like a lot of people are circling a 2 to 3 week sort of time frame here, which would basically put us to the end of May, where it's okay, we want to actually see something, hear something. I do think from other catalyst standpoint, the data that will start to come in over the next couple of weeks is going to start to be interesting too, right? You're going to get an April inflation report, which could in theory have some level of tariff impact into it. You're going to get, then pushing it out again over the next 2 or 3 weeks, you'll get NVIDIA earnings. You'll also get data from May that will start to trickle in at the beginning of June, and does the jobs report hold up? Now we're talking about a month down the line, but does that continue to hold up? You're going to start to get impact from the tariffs that actually comes through in the data in the next couple of weeks, and that feels like where it's going to be a big test for this rally.
Well, the other catalyst could come from the Fed. If we hear them talk about any type of the balance sheet implications that they're kind of navigating through at this portion, and maybe not all out saying we're starting this major process of quantitative easing and in the absence of cutting, that is something that the markets could view as a near-term catalyst as well.
For sure, Brad. And I think the other thing I'm interested with this Fed meeting too is you've seen this big move in sort of investor expectations for rate cuts this year, right? Last week, investors were expecting 4 rate cuts. Now it's already down to 3 in less than a week post that jobs report. So it seems like investors have started to come to a realization that maybe the Fed won't cut that much this year, and maybe those rate cuts aren't coming in June. They might start in July. They might start later in the year. But if Powell actually says that tomorrow or sort of insinuates that, do markets still take that in stride, right? Sometimes you have these expectations going into a Fed meeting. Fed Chair Jay Powell says something that he's said before, said something that the market felt like it understood, but you still get a negative reaction to that, or perhaps a positive reaction to that. There's usually some kind of sharp move, even if he's just confirming what people felt. So I think it will be interesting to see what direction we go come, 3 o'clock tomorrow.
Yeah, very exciting to keep an eye on that meeting. As always, the most important since the last, Josh. Thank you so much. Really appreciate it. Let's take a look at shares of Ford moving to the downside after the automaker suspended its guidance for the full year, citing uncertainty due to tariffs. While the president limited some of the scope of the tariffs on the auto industry, Ford is still estimating a $1.5 billion hit to its adjusted earnings. Joining us now with more on how Ford is navigating trade policy, Garrett Nelson, CFRA analyst. Garrett, always great to talk to you. Talk to me about that $2.5 billion gross tariff impact number that Ford came to. How are you thinking that they got to that level of impact, especially given about 80% of the vehicles that they're selling in the United States are assembled here?
Sure. Thanks for having me. I think, it's not a surprise that what they guided for in terms of tariff impact was much smaller than GM guided for, $4 to $5 billion last week. As you noted, a lot more of Ford's production is in the United States. But I think what you're seeing today, despite this beat that they reported after the bell yesterday, if you look at the full year or the adjusted EBIT that they posted in Q1, it was about $1 billion. But that was pre-April 2nd tariff. The entire quarter was completed before those tariffs went into effect. And so if you annualize that, that only comes to about $4 billion in adjusted EBIT. And of course, the guidance which they suspended for the full year was 7 to 8.5. So, just looking at the results, while Q1 is normally the weakest of the year due to seasonality, the results were still pretty weak, and I think point to some larger issues, taking place at Ford, which we don't think is anything new. So, we think they still have some issues there at the company.
It's really interesting because we heard CEO Jim Farley talk about on the call transforming Ford into a higher growth, higher margin, more capital efficient, more durable business. How much more challenging does that get if you're incurring expenses additive because of tariffs, and then you have to decide which of those you're actually passing through to consumers who are already feeling their own pressure?
Well, I think there's a lot of frustration among investors and shareholders because that same language is the language we've been hearing ever since Farley became CEO of the company in October of 2020. So here we are 4.5 years later, and they're still struggling to drive down costs and create a much stronger company structurally. So
why do you think that is, Garrett?
I just think it's poor management, to be frank. They just haven't done as good a job managing the portfolio as General Motors and others have. Others who are picking up market share in the U.S., such as Toyota, Hyundai, Kia. Ford has lost pretty significant market share over the last 5 to 10 years in the U.S., its core market, where essentially all of its profits come from.
So talk to me then about the degree to which Ford has pricing power versus some of their competitors in the space. They said that their guidance would include price hikes and that they'd adjust their prices based on their competitors. So that makes me think that they're going to wait until somebody else blinks first on lifting prices.
Well, Ford has had a little bit of a rebound in sales. We know their U.S. sales are up 3% year to date. That's through the end of April. So that's a positive. But the big problem in our view right now is that several years back, Ford made a decision to phase out essentially all of their sedan and compact car models. So they produce no passenger cars aside from the Ford Mustang. So it's basically an all truck and SUV portfolio. Because of the affordability issue and the pressures that consumers are under, they're struggling, with those big ticket trucks and SUVs. So I think, that's why they've really lost market share and why they've struggled relative to some of their competitors is just the lack of, smaller, more affordable vehicles that are really popular with a lot of consumers right now.
For investors that are trying to figure out and best look out into the future for what the true kind of turnaround story may look like for Ford longer term, what should they be how should they be evaluating the stock price here today and deciding whether or not it's at a point that's worth kind of setting a longer term target for in their own portfolio?
I think the turnaround story largely hinges upon their ability to bring more hybrid models to market. Hybrids are the fastest growing segment of the vehicle market. It's growing even significantly stronger than the pure battery EV market. So, and Ford has had a lot of success with some of their hybrid models, the F-150 hybrid, the hybrid version of the Maverick. So I think it's, if you're positive on the stock, you're looking for a catalyst, it would be Ford bringing more of those hybrid models to market and regaining some of the lost market share. So, I think that that would be part of it. But looking at the stock has been pretty much range bound for the last 3 years. So it's currently trading right near the lower end of the range. However, they have a lot of cash on the balance sheet. They have $27 billion of cash, $45 billion of total liquidity. A nice dividend yield that's yielding about 6%. So it's hard to say that the stock is a short, which is why we have a note out in the aftermath of this earnings release, maintaining our hold rating on the stock.
Garrett, good to see you. Thanks so much for taking the time here breaking down Ford's results.
Thank you.
Shares of Palantir plunging today, despite beating expectations in the first quarter and hiking its full-year guidance. The stock's solid quarter seemingly not enough to soothe some fears around the software giant's lofty valuation. Palantir stock has risen more than 60% so far this year. Joining us now to dive further into the most recent quarter, we've got Louis DePalma, who is the William Blair Research Industrials Analyst. Louis, good to have you here with us. There's one kind of major number that a lot of people who are lighting up the Yahoo Finance platform will see, and that's the PE ratio around this stock, which just tells the story about how far run this valuation is still trending right now. I want to get your analysis on that compared to what we heard in the quarter.
Yes, and thanks for having me on the show. In terms of the valuation, you brought up the PE ratio, and quite honestly, it's in the stratosphere, and investors are assuming that the company can maintain 30% or 40% plus growth for the next 5 years with that type of valuation. For some context, the company's valuation trades at 64 times 2026 consensus sales, and CrowdStrike is the second highest name in all of software in terms of its valuation at 18 times sales. So Palantir theoretically could fall by 70%, and it would still be tied as the most expensive name in its entire software peer group. So the stock is not cheap by any stretch, but you are paying for quality here as the results were pristine.
So talk to me about those fundamentals. Obviously, the valuation is of concern, but I know in your notes you said that you also see revenue growth slowing in the second half of this year. You said that the numbers are pristine. Is this the last great Palantir report, at least for this year?
No, we think that there's a potential for the revenue growth to decelerate in the second half of the year or early 2026. However, if the revenue growth decelerates from 39% to 36%, those results are still off the charts. They're still among the best revenue growth in the entire software universe. And then if you combine it with the fact that the company, achieved a 44% operating profit margin, last quarter, and in all likelihood, that's going to continue to trade higher. The run, isn't necessarily done. It's just the fact that since there is no valuation support, the stock could go down while the company continues to execute in a very impressive fashion.
What's a realistic growth rate that investors should expect going forward, and where would those contracts, where would those portfolio clients come from, especially knowing that they have some heavy government exposure, and some governments, especially here in the US, have been looking across where they could cut costs, which was one of the concerns actually for Palantir earlier on, even before Liberation Day?
Great question. We think the growth rate over the long term will probably be more along the lines of the mid-20s versus the most recent 39% in the last quarter. And as it relates to logos, we do extensive government contract analysis. We brand our tracker as the dotted line. And there are several awards in Palantir's pipeline. One award that we discussed in a note is called Next Generation Command and Control, in which Palantir is partnering with L3Harris. There's another award called Golden Dome that Palantir is also likely partnering with L3Harris and Voyager Space and Technologies. There's 2 awards for DISA. There's an award for Indo-PACOM called Joint Fires Network. The company has continued to add to its Maven platform. It announced the big deal with NATO. So there's a ton of stuff in the pipeline that should enable the government momentum to continue. And then switching to enterprise, there's a lot of stuff there too.
There certainly is plenty to unpack with this name, Louis. The stock down a little over 8.5%. Thanks for joining us. Appreciate it.
Excellent. Thanks.
Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street, taking a look at the major averages under a bit of pressure this morning. We'll also break down what to expect from the Fed as the central bank kicks off its meeting in Washington. And we'll sit down with the CEO of Mattel as tariffs hit the Barbie maker. We're going to discuss that and much more on Morning Brief ahead. Treasury Secretary Scott Bessent will testify Tuesday before the House Appropriations Subcommittee. Joining us with the details, our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning. Treasury Secretary Scott Bessent said to testify before the House Appropriations Committee this morning, where tariffs and taxes will be front and center. Both are part of the administration's push for what Bessent calls the 3-legged stool: trade, deregulation, and tax cuts when it comes to their plan for boosting economic growth. Now, while Bessent is likely to be peppered with questions on clarity when it comes to trade and tariffs, he will also be asked about questions about the administration's plans for taxes and deregulation. Recall that Bessent has been one of the leads for the administration when it comes to working with Congress on the big, beautiful tax bill. And so it will be interesting to see whether we see some of those conversations with lawmakers spill out into the open. We know that Bessent and the administration have been pushing for 100% expensing on factories and equipment to ignite growth. Also, no taxes on tips tax and overtime. A report in the Wall Street Journal this morning saying that lawmakers are considering phasing out tax breaks on those who work overtime, earning $100,000 for singles, $200,000 for married couples. We'll see if we get any clarity on that during this morning's hearing. Representative Lucas, who is a member of this committee and also the lead for the House's task force on monetary policy, is also expected to question Bessent about the health of the Treasury market. As we all know, the Treasury Secretary has been pushing the narrative of a lower 10-year Treasury yield to help with borrowing costs. The congressman is also concerned about liquidity in the Treasury market when it comes to the supplemental leverage ratio, and will be pushing Bessent on that front as well. This hearing getting underway on Capitol Hill right here at 10 a.m. Back to you.
Jennifer, stick with us for a hot second. The FOMC's May meeting, that's beginning today. What can you tell us there?
Yeah, Brad, across town, Fed officials are gathering for the first day of their two-day policy meeting here in Washington, where they are widely expected to hold interest rates steady, even as President Trump has repeatedly pressed the central bank to cut interest rates. Though a bit of news here this morning, Kansas City Fed President Jeff Schmidt will not be attending the FOMC meeting here in Washington because of the death of his wife over the weekend. In his absence, Kansas City Fed's first vice president will attend, and Neil Kashkari, president of the Minneapolis Fed, will vote in his absence. Now, the real show tomorrow is going to be Fed Chair Jay Powell's press conference, which will be front and center, where he is likely to be asked by reporters about the president's push for preemptive rate cuts, as well as Fed independence in the aftermath of President Trump's threat to potentially fire the Fed chair, only to then relent. Now, the Fed officials are expected to reiterate that they need further clarity before on the impact of President Trump's policies, I should say, before they chart a course forward on the path for interest rates. Recall on April 16th, it was Fed Chair Powell's comments that the economy is expected to move away from the Fed's dual mandate goals for both full employment and price stability that set off President Trump. If Fed officials are expected to reiterate that at tomorrow's meeting, it'll be interesting to see how the president reacts. Brad?
Right. Jennifer, a lot to keep tabs on there. Thanks so much for breaking this all down. We'll be checking in. We've got all your markets action straight ahead. Stay tuned. We're counting you down to the opening bell on the other side of this short break. You're watching the Morning Brief. There you're taking a live look at the opening bell at the New York Stock Exchange and at the NASDAQ. You got a great view of all the flowers, 1-800-Flowers ringing the opening bell, one of the annual traditions at the NASDAQ. A bell ceremony celebrating Mother's Day out there. Don't forget to place those orders for some flowers. And at the New York Stock Exchange, celebrating their recent national championship, you've got the UConn Huskies women's basketball team represented by head coach Gino Uriema. Take a look at where we begin today's trading session here on the day. The Dow Jones Industrial Average starts the day down by about 0.8% here. The NASDAQ composite, you're seeing that calibrate right now and ultimately move lower, as is the S&P 500. That's down by about 0.9%. Taking a look at the S&P 500, 11 sectors here. The day after we saw that win streak snapped, but taking a look at where we begin today's activity, yeah, it's technology. That's actually the biggest lag on the 11 S&P 500 sectors. Energy moving higher, utilities holding on to some gains there. We'll see how things transpire over the course of the rest of today's trading activity. But since we did see such a kind of leg lower here, at least to start the day in technology, let's take a look at where that's transpiring the most. Palantir begins the day down by about 10.5%. That after earnings results. There was a lofty expectation that was out there knocking around among investors, and ultimately Palantir taking just a little bit of a move lower here to start. Well, no. dive lower by about 10% to start off today's trading activity, but actually take a look at the year to date. The company has still moved higher over the course of 2025 by about 48%. All that in consideration and in context here, let's also take a look at some of those mega cap tech stocks, those Mag 7ers out there. You've only got one really in positive territory right now, and that is Apple. Shares flat but to the upside right now by about 0.2%. Nvidia pulling back to start today's trading activity by about 2% there. Meta Platforms down 1.4%. Google or Alphabet, whatever you're calling them, call them in the red. They're down by about 1.8%. Also here, just briefly, I want to take a look at the Dow 30 components just to set up today's trading activity. We've got a lot of red here on the screen, just a handful of positive moves here. And right now, rounding them out, and I'll rattle them off because there's so few of them. You got Chevron, you got Verizon, you got Apple, and you've got Caterpillar. Bringing up the caboose there. To no surprise, Nvidia again here. Let's get to Yahoo Finance's Jared Blickery for a deeper dive at what's moving after the opening cross. Hey, Jared.
Thank you, Brad. Yes, all good streaks must come to an end. For anybody tracking the S&P 500, I'm going to put a year-to-date chart in here, and this shows you the recent decline, but I want to draw a moving average. This is going to be the 200-day moving average, and you can see we have stopped just short of it, and that is a key technical level for traders. Not the end of the world. It just means that things have paused, and maybe traders need to regroup a little bit. I can show you the NASDAQ, very similar situation, and not so much in some of the other indices, but it does carry a lot of weight, so that's something I do like to pay attention to. Want to take a look at the bond market. I'm going to take these averages off. There we go. Looks like the 10-year T-note yield is now flat, but earlier we did hit the highest level in a couple of weeks. Also seeing the U.S. dollar decline a little bit, so continuing this latest trend that we've seen where they move opposite each other. That is yields and the dollar. I want to get to some of the sector action. Cyclicals leading down, headed by tech, consumer discretionary also in sights. But look at energy. Energy is up 0.2%. If we have time, I will get to crude oil in a little bit. Brad was just showing you the NASDAQ 100. I'll just reiterate, a lot of red there. Tesla kind of leading the way down among those Mag 7 stocks. But I want to get to the futures market and show you what's happening with gold, because gold is on the rise once again. This is the second day in a row. I'll put 2 days on here on this chart. 2 days it has been up 2.5%, and you can see from Friday up pretty substantially. And if I show you the year to date, you can see how close we are to these record highs. Not quite there just yet intraday, but we are approaching. Also want to mention that gold miners are also popping here, and I want to leave us with crude oil because I've been following that closely. Here is the year to date in crude oil. Hard to see, but this is the best date for crude in several weeks, about 4 weeks. And so crude oil sinking to those 4-year lows. We want to see that kind of rebound and stabilize, not because we want higher energy prices, but we want a good barometer for good global growth here. Back to you guys.
All right, Jared, thank you so much. Let's take a look at shares of Mattel right after the opening bell here on Wall Street, up about 1%. The maker of Barbie and American Girl moving to the upside. Let's send it over to Yahoo Finance executive editor Brian Sozzi for more.
All right, thanks so much, Madison. Yes, joining us right now is Mattel Chairman and CEO Ynon Kreiz. Ynon, always great to get some time with you. So stock is reacting, I think, a little bit better than people would have thought, given some of the things you had to say on that earnings call last night. Top line looked good in the quarter, but a lot of focus on your guidance and the fact that you pulled it. I know you don't take that decision lightly. Why did you have to pull it here?
Well, great to see you, Brian. Let me start by talking about the quarter, which was a strong start of the year with top-line growth, gross margin expansion, and continued operational excellence. We're also off to a strong start in the second quarter with consumer demand up double digits. Our brand portfolio, flexible supply chain, and balance sheet are clear advantages during this uncertain time, and we're maintaining our target of $600 million of share repurchases this year. As it relates to guidance, given the volatile environment and evolving U.S. tariff situation, it is hard to predict consumer spending and our sales in the U.S. In the remainder of the year and the holiday season. So we are pausing guidance until we have sufficient visibility. That said, we are confident about the mitigating actions we are taking, which are designed to fully offset the potential incremental cost impact of tariffs.
And just 3 months ago, Mattel was a company seemingly firing on all cylinders. You were looking for earnings this year, $1.66 to $1.72. Is it fair to say that these tariffs, 145% tariffs, and you make close to a little bit less than 40% of your products in China, that these tariffs would wipe out all of your profits for this year?
What we did say is that when it comes to tariffs, the mitigating actions that we're taking are designed to fully offset the cost impact, and this includes accelerating diversification of our supply chain and further reducing reliance on China-sourced product, optimizing product sourcing and product mix, and where necessary, taking pricing actions. In terms of the tariff impact, what we said on the call is that the potential impact, assuming current tariffs, the incremental cost exposure this year will be $270 million, but this does not include any mitigating actions or offsets. And as I said, we're confident in our mitigation actions, which are designed to fully offset the incremental cost impact.
And on how much will toy prices go up this year because of tariffs from a Mattel perspective?
When it comes to pricing, we work very closely with our retail partners. We always have the consumer in mind and make sure that we offer great product with the right balance of quality and value at affordable price points. We take a strategic approach, and under the tariff scenario that we see today, we assume or we expect that between 40 to 50% of our product in the US will be priced at $20 or less. I'll give you just a couple of examples. Hot Wheels basic car, the #1 toy item in the world, we sell for just over $1. And an Uno pack, the #1 selling card game in the world, we sell for about $6. So our diversified and flexible supply chain is a clear advantage for Mattel that will help us keep prices affordable for consumers in this period of uncertainty.
Now, a new report out of the Toy Association, they're saying about 50% of small and mid-sized toy businesses could go out of business within weeks, if not months, because of these tariffs. I'd love to get your thoughts on that.
Yeah, look, there's no question that tariffs are creating a real disruption in the industry. And as you said, 80% of toy production globally is from China. And many companies are very exposed. Some companies make 100% of their production in China. So companies have stopped production and shipping to the US as a result of tariff on China. We do support the Toy Association advocacy for zero tariffs on toys to ensure that safe and affordable product remains accessible for everyone, given that toys are such an essential part of children's lives. For Mattel, it is a very different situation, given our scale, brand portfolio, and diversified and flexible supply chain, and that we index at less than half of industry average of product coming from China. In terms of US imports, less than 20% of our global production come from China, and we plan to reduce that below 15% in 2026 and below 10% by 2027, with additional contingency plans to accelerate that if required. So we expect not only to manage through this volatile period, but to strengthen our competitive position and as our standing as a trusted partner for retailers and consumers.
Ynon, I have to tell you this, and I don't say this lightly. I talk to other toy manufacturers, and this tariff situation has been a punch to the gut for them. It fundamentally changes how the toy business runs. Are we looking here at potential toy makers just shipping products, a doll with no hair, a doll with no arm, a doll missing fingers here, because now these products can't be made at a profit in China? What's the end game here?
Look, at Mattel, we are committed to the uninterrupted supply of quality products at a wide range of affordable price points to children and families around the world. This is what we do. We are very good at managing complexities, and we are ready for the challenge.
And lastly, Ynon, I'm sure you saw the president's comments saying that maybe in this land of tariffs, children would have to go with maybe 2 dolls instead of 30. If you were sitting next to the president, what would you tell him about a comment like that?
Well, we all know the importance of toys in children's lives and how much toys make a real difference in a child development. At Mattel, we create innovative products and experiences that inspire fans, entertain audiences, and develop children through play. And we are very committed to this mission, always having the consumer in mind.
All right, we'll have to leave it there for now. Mattel Chairman and CEO Ynon Kreiz, always great to get some time with you, and we look forward to catching up with you soon.
Thank you, Brian.
All right, and do stick around. Much more ahead on Yahoo Finance.
It's time now for today's strategy session. The S&P 500 recovering its post-Liberation Day losses, up 14% from the April 8th low. Goldman Sachs, though, saying this is typical behavior of a bear market. So are we in the midst of a bear market rally? Joining us now, Marvin Lowe. He is State Street's senior global macro strategist. Marvin, great to have you here. Would you describe this as a bear market rally?
You know what? I think that given how aggressive the rebound has been, in an environment where we still have a great deal of uncertainty, you know, we've really taken a lot of the good news out that can come out of it. And, you know, we have to be aware that there's still a lot of significant risk that we're going to have to absorb over the next couple of months.
Marvin, as you assess all of the major kind of keys that would actually have to take place and come forward from this juncture to continue to propel the market and sustain a rally like this, I mean, a Fed that might start cutting rates would be one of them, or pivoting, well, not pivoting, but continuing in its cutting that was initiated last year. And then additionally, any type of clarity around a deal that could potentially come forward when we've only heard that talks are underway, but it's kind of a he said, she said type of thing at this juncture.
Yeah, completely agreed. I mean, we would not only need to have a deal, but we'd have to have a global deal. And really kind of this piecemeal approach doesn't lend itself well to really having that kind of global deal. I think what we would need to have is clarity from the perspective that we know that tariffs are going to be at a certain level. They're not going to increase. Companies can therefore, you know, get back into their planning mode, and then the consumer could get a little bit more comfortable that, you know what, I don't need to rush buy, or I don't need to like change my consumption patterns. That would give the Fed some clarity. Nobody has any of that at this point, and I think that that's the real challenge that all of us are dealing with.
How does the market leadership or the market laggards even inform how you're thinking about where the trade is heading? Particularly, I'm taking a look at things like energy under pressure, materials under pressure, consumer staples under pressure. That's not necessarily indicative of a market that's pricing in a recession. What does that tell you about where we're heading?
Yeah, I mean, I think that's the degree of uncertainty that we're dealing with. You know, we're in a very strange type of drawdown. You know, it was one that was prompted by global recession fears, but it wasn't driven by, you know, any data that was falling off a cliff. It wasn't driven by, you know, tightening credit that really surprised the market. It was driven by, you know, really some administrative policy, which is, you know, generally not a type of situation that the market deals with. So, you know, right now, I think getting towards kind of your neutral type of balance and waiting to see how all this evolves is, you know, a decent strategy, and it's a strategy that we've seen our institutional clients really approach kind of the uncertainty that we're all looking at right now.
I believe over the course of 2025, we're taking a look at some losses, most severely in sectors like consumer discretionary, which makes sense given some of the unease among consumers right now. But the other one that I think is going to catch a lot of investors and has caught a lot of investors' eye is information technology. I think that's down, last I checked, by about 8.7% here over the course of the year to date. How likely is it that we would have any opportunity to get back towards some of the levels that we started off the year at if we didn't have participation or a reversion to some of those highs in information technology and in the broader tech sector?
Yeah, I mean, you know, remember that you know, the market to a certain degree, but certainly the IT sector in general is dominated by a handful of names. Certain of those names are very much tied to the maelstrom, if you will, around these tariff discussions. if we're actually, again, able to get some clarity around how trade talks are going with China, how trade talks are going with some of our larger partners on the technology side of things, we might be able to, because their earnings are still stellar. We are seeing kind of this sector lead from an earnings beat perspective. Granted, there's so much uncertainty in the next several quarters that you see guidance being pulled right and left, but kind of that leadership in terms of what they could do from an earnings perspective, what they could do from a cash generation perspective, and how that leads one to a buyback type of discussion is still there to a large degree.
Marvin, always great insights and analysis. Appreciate the context here. Thank you.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host and Morning Brief co-host Madison Mills for a look at earnings expectations.
Yeah, Brad, so far so good when it comes to first quarter earnings results. We're about 3/4 of the way through this earnings cycle. It's not the results so far that are the issue. The guidance is the issue. Take a look at this chart behind me from Torsten Slok. This looks at the S&P 500's earnings forecast after Liberation Day for both the second quarter of the year and the third quarter of this year. And as you can see in both of those cases, a huge drop off after that so-called Liberation Day here. You can see those forecasts coming down, and that is the key problem for this earnings cycle. It's that guidance. Still, corporate guidance here at 10-year lows. The weekend outlook suggesting that earnings did peak in the fourth quarter of last year, 2024, and results have doubled from a year ago, but are still down a tick from the fourth quarter as well. As we were just speaking about with Marvin Lowe, energy, materials, and staples are on track for profit declines. And that is not what you would see heading into a recession, but that's what the guidance here, as you can see, moving to the downside, could be indicating. Also of note, companies that do cut guidance historically trend down in the quarters to come. Brad?
All right, excellent breakdown. Maddie, appreciate it. Coming up, we'll discuss some of the top trending tickers on the Yahoo Finance website. That's next when Morning Brief returns. We're taking a closer look at some trending tickers this morning, and we're looking at DoorDash, Constellation Energy, and Marriott. First up, DoorDash announcing it's buying hospitality platform 7Rooms for $1.2 billion just hours after confirming plans to acquire the London-based food delivery company Deliveroo. The acquisition of 7Rooms is expected to close in the second half of 2025. 7Rooms competes with the likes of Resy and OpenTable. And along with the acquisitions, DoorDash posted its quarterly earnings showing a beat on marketplace gross order value in Q1, as well as a strong outlook in that category in the second quarter. I know that I did at least my fair share to add to those numbers in the financial performance.
Oh, didn't we all? I mean, listen, the recession may be or may not be coming, but we're still delivering our food. No, having said that, for DoorDash, it's really interesting, right? First quarter revenue up $3.03 billion. That was up 21% from a year ago. Having said that, though, that it clearly was not enough in terms of the amount of cash that the street was looking for DoorDash to be pursuing some of these deals. When you have this 7Rooms deal for $1.2 billion, also the announcement of that Deliveroo deal, perhaps there's a question about the amount of cash that DoorDash has available to be pursuing deals like that. It's also interesting in the company's outlook, they did not mention any impact on tariffs, but they did note that an international presence could leave it open to geopolitical and currency risks, obviously with an expansion abroad with that Deliveroo deal here for DoorDash here. So I think it's interesting that they didn't mention any kind of slowdown that could be attached to the macroeconomic environment, given that we've heard about that a lot on the other calls here. And plus, Constellation Energy falling to the downside after reporting adjusted operating profit and EBITDA for the first quarter that did miss expectations. The company also maintaining its full-year outlook with adjusted operating earnings per share of $8.90 to $9.60, with the midpoint missing the street's estimate. Taking a look at why you are seeing the stock moving to the upside, because it's really interesting, is that the stock actually fell sharply pre-market this morning here, and now you are seeing a little bit of a rebound here. So why is that? Perhaps it's the reaffirming of the company's full-year outlook here. Earlier this year, the company had entered into an agreement to acquire another company, the nation's largest clean energy provider, Calpine. That transaction is expected to close in the fourth quarter of this year, so perhaps some excitement related to that, and also hearing the company talk a bit about policy as well.
Yeah, I think that there is certainly some runway that the company has when talking about clean, reliable power. The company and their CEO, the executive team, the chief financial officer, Dan Eggers, saying that they're uniquely positioned to provide durable value in this evolving landscape. And think about where that landscape is evolving. There is more demand that is going to come forward from data centers for solar and renewable energy as well. And perhaps Constellation sees a major opportunity within that. They also talked about what is vital for national security as well and their economy and in this AI race, and Constellation views themselves as a core cog within that broader engine as well. Lastly here, let's go to the stays, the accommodations. Marriott is the latest hotel company to lower its full year guidance. The company expects revenue per available room in 2025 to increase by 1.5% to 3.5%. That is down from prior projections of 2% to 4%. It comes as hotels contend with economic uncertainty. Hilton, Hyatt, and Wyndham have all lowered their guidance for the year. CEO Anthony Capuano says despite the uncertainty around the economy, Marriott is confident in its portfolio, loyalty program, and business model in terms of long-term growth. Shares are up right now, 1.4%.
Yeah, it's interesting to see that share price action moving to the upside here after they trimmed their 2025 room revenue forecast and projected second quarter profit coming in below expectations here. The company also the latest to signal a slowdown in travel demand moving forward as there are questions about the health of the consumer. Well, that's going to do it for the morning brief this morning, but you can join me in the next hour for more analysis on Catalyst and then Brad for Wealth after that. Stick around.